Good afternoon. It's our Tuesday. As usual, I am bringing to you a really hot topic just because we come across that 2 times in the week. It is called insurance claims, taxable or not taxable. Of course, here when we say taxable or not taxable, we're referring to income tax, right? We're not talking about payroll taxes. We're not talking about estate tax. We're talking about just income tax. Like when you get insurance claims, do you supposed to report that on your 1040 or on your business tax return? Let's just run through a couple of important ones, right? The most often seen ones. So this is our firm's website. Before I get into the content, I always want to impress you with how we are, who we are, right? We are Community CPA, and we have been on market serving clients and business clients since 1998. So this is our website, communitycpa.com. You can come here to onboard with us without even talking to us. So if you are a business owner just busy, but you have us in mind, then you can come over to onboard with us right here, click the button and uploading your information, and we will come back to you. And of course, you can make appointment with us if you have one-off questions. So confusing, you did all your Googles and you're still confused, not sure whether you are reading it right or wrong. You just want a confirmation from professionals. There you go. You have an appointment button. You can see us there. Of course, all of our webinars here on this channel is posted, deposited in YouTube channel under Community CPA. If you miss 3 o'clock all the time because that is your nap time and you just don't want to work, that's totally okay. And what I want you to do is to come to YouTube channel Community CPA and then subscribe to our channel. You always know the topic. Then you can come over here to look at the list of videos we have. Yes, the website says we have over 1,400 videos available. I thought it's a lot more. You know, Catherine must be hiding some good ones away from you. I'm just kidding. But this is the videos number we have. We have about 7,000 subscribers, so we want to add you into the list. Please subscribe to our channel. Of course, I had written these 2 books already. They're on Amazon. If you like me to autograph your books, and just call the office, and we have the books in the office, and we can have your autographed book available to you. All right. And with that, I want to go ahead and show you the no responsibility disclaimer. This is like a disclaimer of responsibility, right? It's literally we are saying that, hey, if you just listen to what Ying is talking about, then did some big life decisions based on what she talked about today on the webinar, maybe before you make that life decision, you should be consulting with the professionals. Maybe it is your brother-in-law, and just show your brother-in-law what you heard. Then let your brother-in-law decide whether this is right or wrong. Then you proceed, right? Don't just trust internet, and don't just look at our webinars as the only source, but we will tell you that, and we put in the webinars responsibly. We do our work, we do our homework, and whatever we say here, and at that time when we present it to you, we from our end, we know we did our due diligence. But time goes, you know, rule changes, like the federal government is unstable. So with all of that, and you want to be staying current. All right, let's get going. What are the insurance payout you normally see? Life insurance payout, right? Car accident payout. What about fire insurance payout that you don't always see, but you heard of other people doing it, right? Having the payout. This payout is a lump sum money. When you got the lump sum money into your bank account, is it taxable or not? That's what you need to know. To know that, come to our webinar or subscribe to our channel and you'll see the answer, right? So let's cover these 3 payout whether they're taxable or not. Life insurance payout. Is it taxable or not? The answer is maybe yes, maybe no. So that's frustrating. That is not an answer. I understand. That's not an answer. But I'll give you a very clear answer this time. Life insurance that you purchased with your after-tax money, which means that it is your saving. It is your money out of your personal account. You've been paying premiums the whole time, and then you die. That life insurance is not taxable. You don't need to report income tax on that. You hear me, right? If the life insurance is paid with your personal funds, you die and your kid got the money, not taxable. But interest earned inside of that life insurance is taxable. And I also tell our client that don't worry about that. You know why? Because the life insurance company would issue you a 1099. It will lay out what is the interest amount, so you'll pay taxes on that. But the payout, the death benefit, is not taxable. All right. Then what if you ask me that, oh, what if I didn't really, just pay out of my personal funds in the big amount. I was doing installment, okay? So, I was telling them that, okay, don't pay me. If I die, don't pay to my kids a $3 million in one shot. I want my kids to get that 3 years, $1 million a year. So if proceeds are paid over time, the principal portion is tax-free, as we already said, because you paid with your personal money. But the interest that accumulated during this installment time, that is taxable. So your kid would receive that interest slip, the voucher, from the insurance company, and they will just proceed paying taxes, right? So what if you didn't die, but you just decide to give the insurance policy back? It is called a policy surrender. And especially if you have cash value in the policy and you withdraw and you surrender your policy, you go like, I can't wait, I'm dying, I just want to cash it out, right? That happens. If the policy is surrendered for cash, the premium paid, not taxable, because that is what you used, your after-tax money, you paid for it. But excess over the premium, yes, taxable, right? So you would know. But in this case, you may not get a clear documentation from the insurance carrier tell you that, oh, this portion is excess, that portion is your premium. You may not get that. But you know what you paid the premium, so you can work with your tax preparer to make sure that you don't overpay it, right? All right, now let's talk about this IRC 101. This IRC 101J is a tax code which takes care of some life insurance that was purchased by the employer on your life, but the beneficiary is the business, not you. Right? So let's say if you run a business and you bought life insurance for yourself. You're the owner of the business, but the beneficiary is not your children, yourself. It is insured on your life, but beneficiary is the business. Because the concern is that if you suddenly die, someone needs to run this business. So you hope that to use the benefit to continue running the business and making sure that the business has money to work with after you die. So these kind of purchase, remember I said, it is the business-owned policy on your life, with your life. We're betting on your life, but you're not the beneficiary. The business is the beneficiary. So that could be on any employees. As long as your employee agree with that, and you could have this kind of policy in your company, the death benefit is taxable to the business, right? And the premium is being deducted as a business expense throughout the time. That is under IRC 101J. So you need to report, the business need to report every year to IRS on Form 8925. Just want to mention that. So maybe you did get payout to your company. Then you want to look at how you did on the premium, right? So that could be just taxable. Company pays premiums, but employee and the owner is beneficiary. So in this case, different from earlier what we talked about, this one is company pays the premium, but if you die and the money goes to you and it goes to the beneficiary you wanted. So, a lot of companies offer those employee life insurance. So you pay, company pays for you, and so it's regarded as your benefit. The death benefit will go to you, your family, because you are an employee and you bought it, but you didn't pay premium. The company paid premium to you. So that premium payment is taxable compensation or is a dividend income. So just know that if it is beneficiary under you or your employee, and under anyone in specific is not really beneficiary of the company, then this insurance policy is really for the benefit of that receiver. If the company pays, the payment of the premium will become taxable income. If it is on W-2, you pay regular income tax. If it is dividend, then you pay dividend tax. So that's taxable, right, on the income tax side. So this is all about life insurance payout. So we kind of understand that whether life insurance payout is taxable or not has a lot to do with the premium where you paid it out of. You may be paid out of your personal funds, then it's not taxable. Only the interest income portion taxable. But if you paid out of your business, it really depends. Whether the business you paid out, it is beneficiary to whom, right? So that's where you need to do analysis to make sure you're paying taxes properly. All right. Now let's go to car accident insurance payout. So when you get a lump sum of the payment for the car, it's written off. It's all gone, no more. And that money, is that taxable or not? Let's take a look at it. When they give you that payout, they already classified what the money is for. So if the money is for medical reimbursement because you got injured, you went to the hospital. You remember when you go to, you don't remember because you didn't have car accident. But when you have accident like that, you go to hospital, they make you fill up a form. They want to know whether this is covered by your normal medical insurance or covered by the car accident insurance. So that's why they make you fill out the form, even though you always go to the same place to see doctor, but they didn't ask you that before. Now they ask you. It's because it is accident. So you need to fill it out. So medical reimbursement, non-taxable. You get that money, you pay for your medical insurance. You pay for your medical expenses. Vehicle repair and replacement. So your policy would written whether what exactly you're insuring. Maybe you're insuring just for repairs, up to what amount, or you insure replacement. Most of the car insurance you buy is replacement value, so they will just give you what that would be. Replacement of exactly the same vehicle. So if you have an old vehicle, the replacement value is going to be that old vehicle. And you may end up not having a vehicle just because it's not enough money. Let's say the insurance company give you a replacement which is bigger than the price otherwise your car worth. That means you have a taxable gain if the proceed exceed your basis. That's the language I have there on the slide. So make sure that you know. So if the car is exactly what you have, then you don't have a gain, then it's replacement. So there is no tax, no taxable income for you. But if what they give you is more than what you lost, then you have a taxable gain right there. If it is business vehicle, then you will look at your balance sheet to see what is the book value of that vehicle. If the insurance proceed for replacement is bigger than the book value, then you have a recapture gain. So those are calculations that you need to understand when you have a vehicle, whether it's personal or business. Of course, if you got injured and you may not be able to work, you have a lost wages, then you got settlement for this and $250,000 lost wages for the past 2 years that you couldn't even get out of bed. That lost wages is taxable. It is almost like replacing your W-2. So you pay taxes on W-2. So of course you pay taxes on lost wages. What about the settlement for pain and the suffering? So the guidance on that, so I give you the revenue code 10482. So it says that physical injury is not taxable. So if there's a $500,000 for physical injury, then you take it back and you take care of your body, no tax. But if it is emotional distress, because of the car accident, I become depressed, distress, right? Inconvenience. All of that is taxable according to 10482. All right. So much about car accidents. So you can tell that you could get your medical bill, you could get your replacement of vehicle, you could have lost wages, you could have pain and suffering. All of these categories, what you really wanted to know is what they are. Don't just get a $1 million settlement and then don't even know which one belongs to which, because it has implication in terms of whether you pay income tax on that or not. All right, third one, fire insurance payout. Your home got burned. You know, burning house is actually, I know it is a devastating event, but we also call fire being getting up and getting better signs. So the fire burning represents that force of growing up, right? So if fire is not necessarily as all bad, we have clients who are they're rating off their one of the houses. They donate that to the fire department to burn it. So it just to burn it, make the fire department to practice how to put out the fire, right? So fire is positive thing. Let's just say home fire insurance. So you got burned and the insurance coming over to pay you. Not taxable if used to repair or rebuild. You know, just to get back to where you were. It's taxable gain if the insurance exceed the adjusted basis. All right. So would that ever happen? Of course it happens. Because we had a case where the client has a beach house. It was an old house. It's really broken, need to be fixed. Then caught on fire. Then of course the insurance policy is to replace the property back in the place. So to build a new one, of course, is went over the adjusted basis. When you went over the adjusted basis means your original base. Let's say that was $250,000. And then when you make it new, it is $500,000. Then your taxable gain is on the other $500,000. So you recover your basis, but you have a taxable gain. But when you have a taxable gain, does that mean that you lose it? You're gonna pay taxes? Oh no, that's bad. I'm going to pay taxes. No. There is an IRC code called 1033. I know folks knows 1031 exchange, but 1033 is really meant for what we call the involuntary replacement. So it's not something you want to do, but it happened to you. So that rule says that you don't have to pay the gain, the taxes on that gain until you replace this property with another property, until you let this property, you sell this property basically, and you exchange this property. So that is a deferral of taxes. So you want to remember that. You don't need to know the code number, and you just want to know that if you got insurance payment, insurance result settlement, which exceeded your basis of cost of the house, no worries, because you can defer that. You don't need to be concerned paying taxes on that taxable gain immediately. All right. What about business property with a fire payout? So basically, the building equipment inventory are not taxable up to the tax basis. Normally, when you buy business property fire insurance, you would cover the interior of the building or the building, if it is yours, equipment and inventory. Your landlord should be the one covering the building structure. Even though you are the one ignited the fire, I mean, not purposefully, but the structure side of damages really belongs to the insurance that your landlord has on the building structure. So you, as a tenant, you would be responsible for inside of the building, the equipment and inventory. Okay, of course, it is taxable if it is went over your basis. So there is a section 1033 we just mentioned about at the primary home residence. Same thing with business property. If you are doing this involuntarily and it's not you wanting to do this, you can actually defer the gain. To defer the gain, postponing the gain until the time that you replace it. You replace it with other property. So there is a delay. It's almost like 1031 exchange, but it's not. It's involuntary conversion deferral, which will allow you to delay the gain. All right. So business interruption is a kind of payment that would come to you because there's a fire, you couldn't work on your business anymore. So the insurance company will pay you up to a certain time, a year, 2 years, up to a certain time of your business income loss. So that income is not your sales, it is your net profit. So, of course, if you say that, well, what do you mean? What if I don't have a net profit because I'm just new to the business? Every month I have a loss, but I do have this real business interruption that need to be compensated. You are right. So the insurance company will actually work with you to calculate what need to be paid to you in that case. But generally speaking, everything related to business interruption, this portion of money, it is actually taxable. Okay, and you want to make sure that you watch what you get, properly separating that. It is that replacement, and is it over the basis, or is it a business interruption? So what is that? So you want to make sure you watch your insurance reimbursement being classified. All right. So now let's just kind of look at a summary of what's taxable or non-taxable. This is what we call the technical framework related to why some insurance proceed is payout is taxed, why some not taxed, right? Here is the form. Replacement type. If it is medical bills, not taxable. If it is property replacement, usually not taxable. Okay, why is usually not taxable? Because if it is over the basis, it is a taxable event. However, you could defer that by section 1033. Capital investment, same. Usually not taxable. Wages and income, always taxable. Business profit, of course, taxable, right? So this will give you a thought of, what outcomes the taxes would have for you when you have these replacement type. Then you may say, well, you didn't mention about the pain and suffering, all of that. Those are not replacement type, right? We're talking about what used to replace your losses. But those physical injuries and, emotional distress and things like that, that's really, it's not going to automatically come to you. You probably do have to go through litigations to get those paid out. Because normally the insurance policy, if you look at, it doesn't really cover that. Maybe physical is covered on the medical, but it's not like they have a punitive damage things for the insurance company to pay you more when you lose a finger or arm or leg, All right. Now, advanced CPA planning strategies. We have a few for you. For life insurance structuring, we want you to understand what kind of money you use to pay. Are you using your pre-tax dollar amount to pay under your company, or you're using after-tax money under your personal bank account? Premium payment determines a lot of things, and also beneficiary. Who are the beneficiary? Of course, you can plan. You can plan the kind of, beneficiary that it doesn't under your control anymore. For example, irrevocable life insurance trust, you can set up to put your life insurance in there, so that will become it is even out of the estate tax if you do that. Of course, we're not talking about estate tax right now. I'm just talking about income tax. So all of the life insurance structure for income tax purposes is really focused on the premiums, how you premium is being paid, and also who is your beneficiary. So that worth a lot of planning, and you want to talk to your CPAs, talk to your financial planners who are selling you the insurance, and ask them about the tax treatment of these insurance. And they often work with CPAs, so you should get the answer. Of course, the fire and the disaster tax planning, the insurance usage, and those insurance, you just need to remember there is an IRC 1033 voluntary conversion. Right here, I put a little bit more words for you because, someone was asking me that, which form do I fill out? No, that's an election. That election is almost like mark-to-market election. It's a statement. So you want to put in the statement and submit that with your tax return. So to have that be in place, be deferred. So this is what, the slides here basically show you how to do that. Then, of course, if you have a primary residence, you have this exemption for capital gains for getting the price go up. So, it's an involuntary conversion, so you can actually use the Section 121, which is the home sale exclusion, to not pay the capital gain, right? So all of this, it is a planning matter, because when you have a disaster happen and you want to immediately think this money you get from the insurance company, how do you plan that? What is consequences for you the year, when you come to the tax filing time? So when you work with the attorney and settling in the agreement with the insurance company, and the best practice, the one advice we would give you is to name out every penny what they're paying for. Is that for medical, for property replacement, lost wages, and pain and suffering? What are they? Don't let the settlement be so vague. That's one of the key things we tell our client when you work with your attorney, and think about the tax consequences of that money. If you don't name it, then a lot of CPA firms would take your proceed and the taxable, all of it. Because if you don't give directions on what is taxable, what is not taxable, then the treatment is always going to be conservative to the IRS. We're going to pay more to IRS, right? Because to pay less or make you not pay, that may not be correct. So knowing that someone has to make a decision on what we are paying for, so your tax result would be accurate. Because this is a highly audited area. When you get a big payout, trust me, IRS knows, because that is already went to IRS as 1099 income you have. How you treat it become very important. All right. So now I want to quickly summarize what we talked about today. Insurance proceeds are taxable when they replace your income, and when it is not taxable when they replace capital, replace health, replace property losses. That's in general. And this distinction is one of the most misunderstood tax issued by small business owners. So it's highly attractive to IRS auditors. They like to audit this. They call it a high-risk area. So whenever you are in doubt receiving insurance payout, you can always check with community CPA, and we are here for you. because the answer is not necessarily yes to all or no to all. It is analysis of how exactly the insurance was being made is important. With that, I'd like to show you on our website. You can make appointment with us. This is the partners link. You can click any one of us, book appointment with us. Insurance side of things is something we work with, have a lot of experience, so you can count on our expertise. And the big thing is we are the tax people, so we know how to treat it. When you talk about income tax or maybe estate tax, those are the things, and we deal with it every day. So make sure that you tap into the resources and getting to know your payout better. Don't just pay taxes on your payout. Maybe part of it is non-taxable. I will talk to you again. Thank you so much.